Okay, let's go ahead and get started. First of all, thank you for joining us. My name is Curtis Congdon. I'm president of XML Financial Group, and I'm glad that you're choosing to be with us this morning. All attendees are in listen-only mode, so no need to mute your phone or device. You're already in listen-only mode. But we very much welcome your questions. So at the bottom of your screen, there's a box that says Q&A. Please, throughout the webinar today, enter your questions. Then at the end, we will address as many of those as possible. For those of you who are new to XML, we are a wealth management firm with offices here in Fairfax, Virginia, in Bethesda, Maryland, in Fort Washington, Pennsylvania, and Breckenridge, Colorado. Along with our affiliated broker-dealer, our advisors oversee and service assets of nearly $4 billion. I'm very pleased to be joined again this year by Jordan Jackson. Jordan is the Executive Director and Global Market Strategist at JP Morgan Asset Management. We're here to reflect on 2025 and look ahead to the 2026 market outlook. So Jordan, thanks for being with us, and we look forward to jumping into things here.
Thank you so much, Curtis. Really excited to be here. Thank you all for having me back. I hope everyone's had a wonderful holiday and wonderful start to the new year. What I'd like to do is just spend the next 25 or 30 minutes or so walking through our broader outlook for the economy, for markets. And I actually hope to strike a bit more of an optimistic tone as we think about our outlook for 2026. So we'll spend a little bit of time talking first about where we think growth is headed, kind of recapping a little bit of 2025 and where we expect growth to evolve over the course of this year. We'll spend a little time talking about this K-shaped recovery, right? So upper income individuals continue to do well, continuing to power the economy, but also a large swath of American consumers seeing a pretty sizable pickup in their refund check or federal refund tax credits over the next several weeks. So we'll talk some about how that could also help to lift growth in the first half of 2026. We'll talk a little about corporate America, corporate profits, how we're seeing the profit environment evolve. We have the major banks having reported over the last week, so we do have a bit of a sense on the consumer and how financials are faring. Where do we see earnings going from here? We'll spend a little bit of time talking about the bond market. Obviously, a lot of volatility with threats to Chairman Powell and worries around broader Fed erosion of Fed independence. What's the implications that might have on the bond market, and how should we think about fixed income in this very uncertain environment? And then lastly, obviously providing some of our broader ideas on where we're seeing opportunities in the market, both on equities as well as fixed income, and also international markets as well. Given we know last year was finally, after quite some time, a really strong year of international performance relative to the U.S. And does, of course, geopolitical risk and the pickup in geopolitical risk that we've seen, kicking off the year with Venezuela, now threats to Greenland, does that change our view around international on the margin? So a lot to dive into. Let's jump right in, and very much looking forward to your questions. So first, I think 2025 can really be described from an economic perspective as a year of resilience. There was a lot of concern around the potential for a recession in the second half of 2025, driven by the weight of higher tariffs, which came into play in late March, early April. So it was expectation that consumer sentiment, overall business confidence and uncertainty was really going to weigh on activity in the second half of the year. But we've actually seen evidence of some pretty strong resilience across the U.S. economy. So you can see that volatile first half of the year. Here we're looking at quarter-over-quarter GDP growth. You can see to the right-hand side, first half of 2025 was obviously a bit choppy. So that negative first quarter followed by that very strong second quarter. And unsurprisingly, a lot of that being driven by trade. And so the tariffs coming into play in the beginning of the second quarter. We saw a lot of pulling forward of purchases in the first quarter. So buying more than we're selling into the global economy. That acted as a big drag on net exports for growth. A lot of that reversed itself in the second quarter. So you can see a lot of those big swings. And over the second half of the year, we continue to see evidence of a pretty resilient consumer. And we know consumption accounts for about two-thirds, a little bit more than two-thirds of overall activity in the United States. And so this very strong consumption has continued to allow the economy to chug along in the second half of 2025. we're actually, a number of models are actually calling for a 5% growth rate in the fourth quarter. And again, a large share of that being driven by consumption numbers that continue to come in pretty strong. Now, what's been driving a lot of that consumption, and it kind of gets back to one of my earlier comments about this K-shaped recovery. And this is a new slide that we added to the guide this quarter, but I do think it does a good job really articulating just how much wealth has been gained over the last several years, particularly concentrated in the upper income individuals. So the left-hand side chart here, this just looks at, again, that cumulative growth in net worth going back to the fourth quarter of 2019. So I think it's quite impressive to be able to say that across the economy, consumers have increased their wealth over the last 5 years by $57 trillion. Unsurprisingly, the bulk of that wealth has been concentrated, or growth in that wealth has been concentrated in the top 20%. So about 41 trillion of that 57 going towards upper income households. And these are individuals who own the stock market, right, be it mutual funds or direct stock ownership, and they tend to own real estate and assets. And all of those, both of those have been inflated over the last several years, helping to drive a lot of these gains in wealth. Now, again, while the wealth story is a big piece of the story, if you look at the top right-hand side, this translates into some of that firmer consumption numbers that we've been seeing, because the top 20% account for 40% of overall spending. And so these upper income individuals are really helping the economy stay afloat, largely on the back of these gains in overall wealth. Now, we anticipate a bit of a pickup in economic growth, still strong growth in the first half of the year. And a big piece of that story is going to be fiscal stimulus. And when you look at the bottom right-hand side chart, what we're actually showing here is the average federal refund check per household by calendar year. And what you can see is that for 2025, that average refund check per household was right about $3,200. We're actually forecasting that the average refund check is going to be about $4,000 for the average American household this year. And so that's obviously an increase of about, on average, $800 per household. And we've seen this story play out before, right? You give an American consumer a dollar, we're going to find a way to spend two. And that's generally going to be pretty good for growth, but also potentially be a bit inflationary. So we'll spend a little bit of time talking about our inflation outlook as well. And I think what's also is worth mentioning that about 60% of federal refunds are paid out by March 31st. So you consider the IRS starts taking tax statements in January 22nd, 26th. A lot of these individuals who are likely going to be the first to submit their W-2s in order to get those refund checks back are probably the individuals that need it, but also going to be the individuals that are going to go out and spend it. And so this is very much a kind of front-loaded impact on growth before things begin to normalize in the second half of the year. To put some numbers around this, just to iron things out, we anticipate growth can run between 3 and 4% over the first half of 2026 before beginning to normalize to a roughly 2% run rate over the second half. Now, while this fiscal stimulus is going to help to stimulate growth, front load growth for 26, it is still going to deteriorate the overall fiscal position in the U.S. We're still expected to run higher deficits, and our debt levels are still expected to increase. So that's what we show on the right-hand side of this page. The top right shows that deficit as a percent of GDP. The bottom right shows the debt as a percent of GDP, and we show the forecast provided by the Congressional Budget Office over the next decade. And certainly continued running higher deficits will continue to contribute to higher debt levels. And so again, the fiscal position continues to be on shaky ground. When we look at the left-hand side, you can really decompose, the sources of revenues as well as sources of overall government spending. That dashed box there is the deficit. So last year we ran a deficit of around 25% of GDP, so about $1.8 trillion. We are expected to run a deficit this year for fiscal year 2026 of right around $1.9 trillion. And the reason why I mentioned that is because this is including arguably the sizable pickup in overall government revenues that are coming from tariffs. And we have seen tariff revenues, the administration using tariffs as a key source of revenue for the government. In fiscal year 2025, The government raised about $195 billion worth of revenues driven by tariffs. Assuming all these tariffs are kept in place, we're projecting that we could see revenues of around $350 billion for fiscal year 2026. So a pretty sizable increase in terms of a share of overall revenues. However, there is a big risk if these IEEPA tariffs are being ruled as unconstitutional. So this slide here just looks at the average effective tariff rate on U.S. goods. We take this back to the turn of the 20th century, and to the far right, you can see our current estimate of around 15.6% of that average tariff rate on U.S. goods. If these IEEPA tariffs are reversed or ruled as unconstitutional, that 15.5%, could drop down could be cut in half to roughly 7 to 8%. So said another way, the government would go from collecting about $30 billion per month in tariff revenue down to $15 billion per month. So that would be a pretty big hit. And that would actually, again, compound some of the challenges that we continue to see from a fiscal perspective in the United States. Now, what does this all mean for us as investors, right? The U.S. government continues to borrow beyond its means. That means we need to borrow and finance this. We need to issue more treasury bonds into the market. And this obviously has implications for things like interest rates, where interest rates could actually move higher, even though you have a Federal Reserve that seems willing to cut rates. So we'll spend some time about our outlook on interest rates. So that's the broader backdrop from the economy perspective. Again, we've continued to see pretty strong resilience in the U.S. over 2025. We think that momentum alongside fiscal stimulus helps to jolt growth in the first half of 2026 before things begin to normalize. We are a little bit concerned about the fiscal position, particularly if tariffs or a large share of tariffs are ruled as unconstitutional. This would exacerbate some of the fiscal challenges by lowering the amount of projected revenues that the federal government is receiving. And we want to be wary about how that could translate to interest rates more broadly. Now, on the labor market, one of the things that we've observed is this sort of low hire, low fire type of environment where we're not seeing mass layoffs, but we're also not seeing strong job gains and payroll growth. And that's really shown on the left-hand side chart where we show the month-over-month change in payrolls. This is tends to be kind of the gold standard in how we measure overall job gains. You can see coming out of the pandemic, so very, very strong payroll growth, right? As the economy opened back up, folks were flooding back into the workforce, so job creation was quite strong. As of the last couple of months, job creation and payroll growth has come to a screeching halt. In December, we added about 50,000 payroll jobs to the economy. However, that 3-month moving average, given some downward revisions to the prior month, have actually brought that number down to slightly negative. So again, this is an environment where payroll growth and demand for labor has been relatively weak. And historically, this would translate to a much higher unemployment rate. However, while we've seen some modest moves higher in the unemployment rate, we haven't seen a spike higher in the unemployment rate. And part of the reason is because there is some challenges, obviously, on the demand side where hiring has been slow, but there's also some issues on the supply side. And immigration has been a big piece to that supply story. So we know the administration has taken a hard stance on immigration more broadly. And obviously, deportations and ICE have sort of intensified sort of deportations and curtailing immigration more broadly. So that's removing a pretty sizable chunk of overall labor supply. And so while demand has come down for labor, also supply has remained fairly challenged. And that's why you haven't seen, on balance, this spike higher in the unemployment rate, really just sort of a gradual move higher as of late. And we did actually see the unemployment rate come down in the month of December, falling 4.6% down to 4.4%. So suffice it to say, so long as the move higher in the unemployment rate isn't being driven by mass layoffs, so far currently is not, I think this puts the Fed in a position where, again, they can stay biased towards easing and cutting interest rates, or unlikely to see aggressive rate cuts down to 3 or 2.5% anytime soon. So, taking a step back and maybe shifting gears a little bit to talk more about, markets. 2025 was obviously another great year. 3 consecutive years of double-digit returns on the S&P 500, 39 all-time highs notched last year, and the market is off to a pretty decent start in January. So you've got the market up about 1.5% so far over the first couple of weeks of the year. But interestingly, you've started to see a bit of rotation. It's not just the Magnificent Seven that are driving markets higher. It's actually other areas of the market, more value, more cyclical names that have been driving a lot of the market performance so far this year. So if you actually break down kind of that 1.5% return that we've seen on the S&P 500 so far this year, the Magnificent Seven's up about 1%, and the rest, the 493, are actually up about 3.5%. So we're finally starting to see that rotation beginning to take shape. And the way, as we think about this from a portfolio perspective, this isn't us abandoning tech. We're not abandoning the Mag 7. We think they are very strong, profitable companies. They continue to grow earnings at a roughly 20% clip year over year. They've attributed to a lot of the margin expansion in the market more broadly over the last several years. But we do think now markets are beginning to reward other areas, more unloved parts of the market after this very aggressive run-up that we've seen in Mag 7 over the last 3 years.
And Jordan, just to emphasize a point here in the bottom left, the year-over-year earnings growth, I think this was one of the pleasant surprises of 2025 is that we saw something in the order of 13% year-over-year earnings growth in the S&P. Obviously, you have it broken down here by Mag 7 and S&P 493. But even looking at those projections for 26, 24% earnings growth on the Mag 7, 12% on the S&P 493. That's a story that's undertold, it's underreported. There's so much headlines around what the administration's doing and valuations and all these other initiatives. But at the end of the day, earnings growth is probably the most highly correlated with future returns in the market. And to many people's surprise, the earnings growth has been and is forecasted to be, continue to be very strong.
That's absolutely right. And there's a big theme emerging, kind of I'll share with you guys a one-liner that I think really encapsulates our view for 2026 from an equity market perspective. And that is value has to get paid before growth turns a profit. So we're going to spend some time talking about this broader build out of the data centers and the beneficiaries that are largely in more value-oriented parts of the market that we think contribute to this rotation. And you sort of hit it right at the nail on the head. I think investors tend to focus on the Magnificent Seven as one cohort. But while we're not abandoning the tech trade more broadly, you have to be more active around that exposure. Because if you look at a year like last year, the right-hand side chart, 2025, only 2 out of the Magnificent Seven actually outperformed the broader market. So you can't just be blindly investing in these hyperscalers, expecting them to provide kind of uniform outperformance. Now, I think the market is being a lot more selective in rewarding those winners and differentiating amongst those losers. But to get to that earlier point about value getting paid before growth turns a profit, we're starting to see that investment. Meta has made announcements of building out data centers. The data center boom is certainly underway. But you need the value companies to build it out. You need the industrial companies. You need the construction and manufacturing. You need the materials in order for this build out. A couple of examples that I think are worth mentioning, a company like Corning, for an example. That was a company up 80% in the market last year, and we think has further upside. They're actually providing the roughly 8 million miles worth of fiber optic cables as Meta is building out this data center in Louisiana. Emerson Electric, that's a company, electrical manufacturing company that is its bread and butter is provide the cooling systems to help to cool down a lot of the data centers, since we know they use a lot of energy and generate a lot of heat. So, again, kind of this concept of this rotation shifting more into value as we start to see this build out really take root in 2026. And we're notably starting to see that some of the earnings numbers, which are very, very important as we think about future returns. So the left-hand side chart here just looks at year-over-year earnings growth by sector in the S&P 500, green being growth, gray being value. you can see as of the third quarter, 4 out of the 5 sectors that have outperformed the S&P from an earnings perspective were value sectors, and 3 of those 4 were cyclical sectors, so industrials, financials, and materials. And so we are starting to see this rotation as value already so far year to date has outperformed growth. Small caps have outperformed large caps. And so we do think as this rotation continues to take root, there's continue to be some further opportunity in other areas of the market outside of the Magnificent Seven. Now, I want to spend a moment talking a bit about inflation. I would say this is perhaps the most hotly debated topic across our team, where inflation is headed. I'm a little bit more concerned about potential inflation, but we're not talking about 8, 9% inflation like we saw in 2022. You know, the debate is, do we see 3.5% inflation? Do we see 4% inflation? So some modest upward pressure on prices from here, but nothing like we saw just a few years ago. This chart breaks down the contributors to overall headline inflation. So you can see where the inflationary pressures are most intense. There's still some disinflation in the pipeline, which I think is a welcome dynamic. So shelter, which is the darker blue bars, we're not seeing home prices and rental prices falling more broadly, but we are seeing them rise at a slower pace than we saw a few years back. So that disinflation is helping to cool kind of the overall inflationary backdrop. Then also energy inflation as well, which is green, you know, in environments in which oil prices are down and could remain fairly low. We're seeing pretty decent prices at the pump as well. So all that disinflation is helping the broader inflation narrative. Now, the inflationary components are still items like tariffs, right? Companies haven't necessarily passed on the full brunt of higher costs on the back of higher tariffs. So when are they going to start to pass those higher costs on to end consumers? When you look at kind of services related inflation, demand, as I talked about, more checks, larger refund checks, individuals going out and spending those refund checks, that could also be inflationary. And, you know, I wouldn't write off the World Cup in North America this year. 11 of the 16 cities are being hosted across the United States. And we're forecasting a pickup about 1.5 to 2 million tourists coming into the country to enjoy those games. And, you know, that natural spending could very well be inflationary as well. At the very least, inflation remaining pretty sticky through the first few quarters of the year. So our base case is for inflation to sort of bubble up to about 3.5%. Could we see inflation closer to 4? Potentially. But I think this leaves the Fed, as we think about the Fed's mandate between labor markets, which are not great, but not crumbling, but inflation, which perhaps still needs a little bit of monitoring. I think on balance, it keeps the Fed biased towards wanting to cut rates, but we may not see those next set of rate cuts until the second half of this year. I think the Fed does go on pause next week in January. I don't think they continue cutting rates. But again, they will highlight that they're still biased, that the next move that they do make ultimately will likely be a rate cut. So this slide just looks at the federal funds rate, showing the gray line. To the far right-hand side, the green bars or the green diamonds show the market expectations. What's the market pricing in for rate cuts from here? And then the dark blue shows the Fed's estimate. So where the Fed believes that policy rates are headed. And so long as those lines are both sort of trending downward, I think we could feel comfortable that the Fed still would like to cut rates, is still biased towards cutting rates. It's just a question of when and how much they cut rates from here. Our view is the Fed can cut rates 1 to 2 times this year. So as we think about us as savers, if you own money market funds, commercial paper, treasury bills, as the Fed is cutting rates, those yields are likely going to come down slightly from here. So that's something to keep in mind. However, just because the Fed is cutting rates and that's directly impacting cash yields, money market fund yields, it may not impact things like your 30-year mortgage, for an example. So I think we want to be careful to differentiate what drives those two factors. And this is, helps to articulate that curve and what rates could come down even as the Fed is cutting versus what rates could actually move higher. And so this chart here just looks at the yield curve, so the spread between very short-term interest rates and very long-term interest rates. Again, think sort of your mortgage. And what this chart shows is that the market is expecting the curve to steepen out. And I think interestingly, the question is, how does this curve kind of steepen out from here? And if you look at the table on the top right-hand side chart, you can see the 3-month, which is very closely tied to the federal funds rate and monetary policy rates. They are expected over the next year or so to come down, as we talked about, as the Fed is cutting rates. But if you look at long-term interest rates, which are influenced by things like inflation, influenced by things like growth, that's actually expected to move a little bit higher over the next couple of years. And so, for what does this mean for us as savers? If we're saving in cash and cash-like instruments, some of those yields are going to come down. But also, that 30-year mortgage rate could potentially move a little bit higher over the course of the next several months and quarters. So just because, again, the Fed is cutting rates doesn't mean that all rates are going to uniformly come down, which is really the key point that I want to make here. And as investors, the way we're approaching the bond market right now, obviously we own both equities, we own both fixed income, is that there is income in fixed income. And we couldn't say that, just 3-4 years ago when the Federal Reserve was at zero before hiking rates very aggressively in 2022. But that really reset that tough period in the bond market a few years back, just reset yields, reset income, and reset our coupons on the bonds that we own. So this chart here just looks at a number of different fixed income asset classes. To the left of that dashed axis shows your investment grade, your high quality, good companies, core sectors of fixed income. To the right show your more extended sectors of fixed income. The gray bar shows the 15-year range of where yields have traded, and that dark blue diamond are where yields are currently at. I would say that so long as that dark blue diamond is trading above that pink bar, which is that longer run median, you're in good company, right? You're getting income, you're getting attractive income relative to recent history, and being able to buy an investment grade corporate bond at 5%, high quality asset backed securitized. So think mortgages, student loans, personal credit cards across consumers who have a 700 plus credit score, and you're able to buy those bonds at close to 5%. That looks really, really attractive. That income is really attractive, and it's high quality income. We feel pretty confident that we're going to be able to clip that coupon. And so, this is an environment where we think, bonds, or necessarily bonds are back, and we think bonds never went anywhere. But we are using fixed income really for that income and that coupon that they're kicking off right now. Lastly, I want to spend a moment just around international markets. We saw 2025, a year in which international performed very, very well. So Europe up over 40%, China and EM up over 30%, Japan up 25%. Still a good year for the US, right? Up 18%. But we certainly need to acknowledge that outperformance that we've seen globally. And I think it's important for us to kind of ask ourselves, is this consistent? Is this persistent outperformance in international? Could we see another year? Or could we see the US outperform in 2026? And it goes back to one of the earlier points that we highlighted is it's going to be critically important really to follow the earnings. If we go back to this slide and you look at the right-hand side, we actually have decomposed where returns came from in international. And if you look at the gray bars, which was a pretty sizable contributor to international market returns, those are the share of returns that came from multiple expansion or valuations or sentiment, right? Sentiment, folks getting a little bit more excited and comfortable by putting money into these global markets. What I would like to see is the earnings. That's the darker blue bars on this chart. And why we remain optimistic about U.S. markets. If you look at the 18% return in the U.S., almost all of that return came from earnings, came from fundamentals. But if you look internationally, a lot of that return really didn't come from earnings. It came from things like currency, so the dollar weakening relative to the euro, and as I mentioned, it came from sentiment. Now, encouragingly, when we look at where earnings are headed, globally, and this is the chart that we show on the right-hand side, where we show earnings growth and consensus estimates, you're generally across the world, whether it be India, Japan, Europe, which has really struggled over the last several years for earnings growth, finally starting to see earnings growth beginning to improve. You're looking at international earnings growth estimated to be anywhere between 8 to 11%. So as we start to see international companies beginning to earn, that does provide a little bit more durability and stability to global markets, perhaps keeping course and potentially outperforming the US over the course of 2026. Curtis, did you want to ask a question on this?
No, it's fantastic, Jordan. Appreciate your commentary here. Do you have additional slides or should we get to questions?
We'll get to questions in one moment, but I did want to kind of make the point on the international piece. Again, this isn't about buying benchmark or not being active in the space. We think you want to be active, and particularly leading into these broader themes within international investing, themes around government spending, normalized interest rates, AI adoption more broadly, and that continued build out story. So, one of the themes that we're, quite excited about from an investment perspective is the amount of spending that we're seeing, particularly coming from Germany, but also broader Europe, and really that spending catered towards military, aerospace, defense. And if you look at that performance of that part of the market, really since October of 2022, so a little bit over 3 years now, Europe aerospace and defense has performed very, very well. If you look at Taiwan technology, which is the green line on the right-hand side chart, that's that build-out story, right? I think what folks get scared of is China's threat towards technological advancement. And don't get me wrong, they're investing quite heavily. But China is really specialized in building the chips that we use today, the chips in our iPhones and our desktops and our laptops. In Taiwan and in parts of Southeast Asia, they're building the cutting edge chips, right? The Honeywells, the Blackwells, the more robust and complex chips that are going to be going into the data center build out. And so, we quite like parts of Southeast Asia as this build out story continues. And then lastly, international developed market banks, very value oriented story. But if you think about an environment just 10 years ago where global central banks were experimenting with negative interest rates, right? You were losing money just by functioning as a bank. And that dynamic has completely shifted, done a full 180, and yield curves are positively sloped. Interest rates have normalized. So profitability has finally returned to European banks, to Japanese banks. And that's really a theme that has played out, and that performance has done quite well relative to U.S. growth. And so, I think, in large part, while there are obviously a number of geopolitical risks out there that could cause some starts and stops to the international story, we continue to be advocates of diversification. We believe the best defense against uncertainty, of which 2026 will certainly see uncertainty, is to be broadly diversified. So I know this is a bit of a colorful chart. We call this our jelly bean chart. I'm more of a Skittles guy, so this will be the Skittles page for today. But each of these boxes represent an asset class. And we track the total returns by calendar year of each of these asset classes going back over the last 15 years. Now, that light gray shaded box that tracks the black line, this is what we would deem to be a well-diversified global portfolio, loosely based to a 60-40. And what you can see is that global portfolio is never at the top of the page. It's also never at the bottom of the page. It's always hovering right around the middle. And that's the point of diversification, helping to smooth out the ride for investors over time. And that diversified portfolio in 2025 did very, very well, up about 16%. And that diversified portfolio so far this year is up a little bit better than the S&P 500 as well. So let me pause and maybe turn things over and open things up for some questions.
Jordan, this has been fantastic. Really appreciate your insights. You and your team do an extraordinary job putting all these slides together and making it palatable for people. We have a number of questions that came in. I'll get to a few of them. The first question was, does this mean that you expect JP Morgan large cap to surge again? So I think generally a question about JPM's expectations for, S&P and Dow year end? Is JPM expecting it to be a positive year?
Yes, we are. So we're anticipating for the S&P 500 mid to high single digit total returns this year. I think investors have gotten lulled into complacency and seeing double digit returns over the last 3 years. I think bringing those expectations a little bit down to earth and, just recognizing that one of the biggest headwinds to the market right now are valuations, right? So the market trading at a forward price to earnings ratio of 22 times forward earnings. That has historically been pretty expensive. And we acknowledge that a lot of what's driving that upside pressure to valuations is the Mag 7 and large cap tech. But they're being supported by the earnings. So let's just say, earnings still grow by 15% for the market this year. Let's say valuations on the market, and this may be aggressive, but valuations correct by 10%. So now the market goes from 22 times down to 20 times. If you look at just the E, that means the E can still rise by 5%, even though you got a pretty big correction in the market for valuations. And so that's how you can sort of square the circle of strong earnings growth, perhaps some volatility in markets because sentiment, maybe isn't as constructive as it's been over the last couple of years, but the market's still being able to deliver a mid to high single digit year. It may not just be as blockbuster as what we've seen over the last couple of years. And specifically for JP Morgan, I think it's more about balance, right? It's not just about tech. It's about tech. It's about cyclicals. It's about value. It's really broadening out your exposure across markets. And I wouldn't be surprised if we saw the market, the equal weight, which has been recently reaching new all-time highs, outperforms the market cap weight over the course of 2026.
I love that. And actually, do you mind going back a few slides where on the right-hand side you showed 2025, wherever it was, it showed 2025 and the earnings growth, dividends, and multiple expansion and how that impacted performance in different segments right here. So to your point there, and this is kind of the Goldilocks scenario I've talked about with folks, is that you can have a very strong dark blue here. You can have very strong continued earnings growth and actually have multiples contract to the point that you just made, Jordan. So rather than that dark gray being additive to performance, that dark gray could contract, could hurt performance, but you still have a positive year. And so again, in my scenario, that's the Goldilocks where we have very strong earnings growth. Multiples actually contract a little bit, but the market still moves higher in terms of price. And then we enter 2027 at a period at which we have a lower valuation, which historically has been correlated with a higher forward return, as opposed to where we are right now at a fairly high multiple, but it's supported by this very strong earnings growth that we have. We'll take a couple more questions. One of them, I'll let you answer this how you think makes sense. Regarding economic growth and the influx of FIFA Cup, does it take in account the 75 countries that Trump has barred from coming into the country by executive order?
It does take into account, right? And I would say that, my initial 1.5 to 2 million, maybe that number comes down slightly. Maybe perhaps we fall on the more conservative end of around 1.5. But this is certainly curtailing potentially some of that tourism and that broader story. But one of the things that I didn't mention, we talked about fiscal stimulus helping domestic consumers. We also could see a pretty big resurgence in overall traditional capex. And so while we didn't get a reduction in the corporate tax rate, there were a lot of tax goodies that have been brought back. So whether that be the ability to expense domestic R&D, you used to be able to break that deductions out over a 5-year window. You're now being able to deduct that spending 100% in year one. There's other various deductions that domestic manufacturers could take as well. And while AI spending has been incredibly strong, the story there is that we could see a resurgence in more traditional capex spending in sectors like machinery, like equipment, et cetera, really also providing a pretty strong tailwind to growth in the first half of the year.
Makes a ton of sense. Appreciate that. Thank you. Let's end with a question about precious metals. There's several in here asking about gold and silver, both of which had terrific performance in 2025 and are off to very strong starts in 2026. Does JPM have a take on precious metals and what the future might be for them?
Sure. So we're constructive on precious metals. We very much believe that they warrant a place in a well-diversified portfolio. Do we think gold's going to run another 50% this year? Not necessarily. But I think in a backdrop where gold serves as an inflation hedge, and so if we're worried or concerned about potential upside to inflation risk from here, gold performs well. It's a hedge against geopolitical risk. And so if we're in this environment of heightened geopolitical risk, whether that be global economy potentially coming on the offensive relative to the U.S. That also is supportive for gold prices as well. And then when we think about the relationship between gold prices and interest rates, so if the Fed is still biased towards cutting rates, while inflation potentially could still move higher from here, that means real interest rates are likely going to be coming down. Now, keep in mind, gold doesn't pay a dividend. It doesn't have any interest. And so there's the relationship between holding gold versus owning a risk-free asset that pays a dividend. And if the real yield that you're getting on a risk-free asset is coming down, that makes the opportunity cost of holding gold come down as well. It makes it a more attractive investment vehicle. So, we quite like gold, given kind of you're in this sort of environment where you've got these three dynamics that could be supportive for gold prices. And arguably in 2025, if you look at global reserves, so global economies, how much do they own as reserves to potentially sell and prop up their currency? For the first time, gold surpassed U.S. Treasuries as a share of overall currency reserves. And so there's continued demand for global economies to diversify away against dollar risk, and they're diversifying into gold, which provides a supportive backdrop. I like silver. I don't like the volatility associated with silver. There seems to be a lot of kind of derivative overlay contracts in silver, so we're seeing some pretty big swings. But I would look at if gold is a precious metal, silver tends to be 50-50 split between a precious metal and an industrial metal. Still has good amount of industrial usage, but also still has obviously some value as like a jewelry item, for an example. And so as a result of that dynamic, we could see further upside from silver, given again this broader data center build out, pick up in more traditional capex as power plants and equipment and items are purchased, while also still benefiting from that still kind of precious metal side of it. So yes, we quite like precious metals, and I would say industrial metals as well in this backdrop.
That's fantastic. We're going to leave it there for today. Jordan, thank you again for your expertise and all the work that you and your team put into these slides and this research. And folks, thank you for taking the time to attend. My encouragement is to work with your advisor specifically on what all this means to you and your specific financial planning objectives. But again, thank you, Jordan, and thank you all for attending.
Thanks so much. Really appreciate it.
Likewise.